Joining us now is one of the authors, Hal Scott. He's a Committee on Capital Markets Regulation president and a Harvard Law School professor emeritus. And the journal, it's in the journal today, Hal, on page A15. And it's kind of a short piece because you didn't really need a lot of data, and you don't go into a lot of the philosophical concerns about, or actually the logistical problems with trying to affect something like this. You purely go to the notion of what it means to be at $100 million of net worth. It's not possible to just go after those people. Everybody would be affected, and I want you to explain why.
Well, basically, Joe, it's because there would be a lot of selling pressure in the market. These billionaires who hold something like 66% of their wealth in public companies that would be affected by this would have pressure to sell to fund the taxes. So that would be putting downward pressure on the market. Additionally, why would you be public and then be subjected to this tax? So this will lead to additional shrinkage of the public market with corresponding growth of the private market. And the retail investor can't get access to those private markets because to invest in a single private company, they have to have $1 million in wealth, and to invest in a fund of private companies, they need $5 million. So they would be highly negatively affected by this wealth tax.
There's as you point out in the provision, there's an exemption for ultra-rich investors who have 80% of their wealth in these illiquid assets. Since 1996, there are 8,000 public companies in the U.S. Today, there's 5,000. I can't imagine very many companies that would want to stay public if they would go after this exemption. And I don't know where you'd be down to in terms of public companies. They'd all go private at that point. And that's your point. No, there'd be nothing to put in your 401k.
Well, there'd be a lot of, I wouldn't go so far as to say they would all go private. But
well, they wouldn't come public. All the best companies would not come public, would they? They'd either go private or the best Silicon Valley companies would not go public.
Well, you'd have to get, the consent of the shareholders. I think it would be clearly those companies where founders had a major share of the stock. Those would all be easily go private. And, more just as importantly, no private company would have the incentive anymore to go public. So all of these factors reduce the size of the public market, which is the only market in equities or debt in which the average investor can invest.
It's not good, perhaps, when you talk about income inequality, but that does rear its head when you talk about these individuals that have $100 million or more, because that brings you to the billionaire class that owns more than $5 trillion in stock. That's 7% of the entire stock market. And then a lot of that would have to be really reevaluated. This is not just a one-shot deal. They'd have to do that every year.
Exactly.
Every year. So there'd be selling pressure on hundreds of billions of dollars of stock every year from this.
Couldn't say it better. You're exactly right. And, another thing that I didn't really have time to go into in the op-ed is that, our public market is the envy of the world. Although it's been shrinking and its competitiveness has been decreasing, it's still really important. And, that jewel of our financial markets would be under a lot of stress as a result of this. So quite apart from, the impact on the investors, just the fact that our public market, which is really important to allocating capital, et cetera, would be under continuing pressure to decrease.